Your residential sales were down. When do you expect them to pick up again? Is it this half now that things are looking a bit better?
What we've said is clearly the interest rate cycle will play into it because it plays into affordability, and our customers are looking for that certainty of what their cost of finance will be. So that'll be a trigger in our view for more sustained demand to return. On our forecasts, calendar 24 is where most of the markets, because of price declines, wages rising, and of course interest rates stabilizing, start to enter what we call green zone on affordability. Sydney does remain very unaffordable, so more maybe price declines in Sydney may be required for that to start to take place over the next 6 to 12 months.
Yeah, I was going to ask what regions of Australia may be performing better than others. So obviously Sydney quite unaffordable, but places like the Sunshine Coast are a bit better.
Yes, Sunshine Coast, satellite areas next to our big cities like Geelong, even in Sydney, down at Wollongong, wherever there's more affordable product, that is still moving. But clearly, when you're in metro locations, the prices do tend to go up, and that is inhibiting demand. But we do see, as I said, 2024, our calendar is where we think the various macro factors should align, because there is continuing to be housing, chronic undersupply of housing in the country. Net overseas migration is kicking in. And of course, we've got strong levels of employment, which are all supportive for a good housing market outlook over the medium to long term.
A lot of companies have also talked to their results about wet weather last year. What impact did that have on your developments?
It certainly had an impact. We had double the average rainfall in the first 6 months of the financial year compared to long-term averages. That did impact our programs, and we have had some of our lots which we pushed into early next financial year. But it's good, it's pleasing to see in most parts of the country the weather has abated. Hopefully it holds up so we can catch up on production.
Are you starting to see signs of price inflation pressures easing, cost pressures starting to come down?
Certainly they are. In our part of the market, the weather did cause supply chain disruptions and bottlenecks. That's eased. Supply chains are easing, but the rate of growth is moderating in construction cost inflation, but it still remains high compared to longer term averages. We see that continuing till the middle of this year at least, because there is still a lot of homes to be built, including in our pipeline. But as we look forward 6 to 12 months from now, because demand has come off, that will read through in production and then eventually into more capacity building into the home building market. So we do anticipate the moderation to start taking place.
And these results, you've also extended your relationship with Mitsubishi Estate Asia. What advantage is that going to give you with those master plan communities?
Yeah, it's part of our key plank of our strategies to, across each of our sectors, to have aligned capital partnerships. And Mitsubishi is an existing client, so we're very pleased to welcome them to our master plan communities business. Where we are looking over the next, as I said, the fundamentals are strong. We do want to replenish our pipeline and grow our market position. And we now have a quality partner like Mitsubishi who will be partnering with us on the new origination, which we will do as the cycle matures.
Yeah, and you mentioned this earlier, but commercial property sector looks like it's been particularly strong, and the retail town centres. So consumers may not be spending as much on buying a home, but they're still spending in retail stores.
Yeah, we're a diversified group, and the diversity of our business has been on display in the half-year results and will be at the full-year results, where our logistics assets, our town centres are really performing strongly, and that's been part of our strategy to pivot to logistics and of course town centres. As I said, those sales growth have continued into January. We are seeing inflation read into those nominal sales, but there's still a lot of pent-up demand through COVID that consumers are now using their savings to buy those things that they didn't buy during COVID. So it is continuing. We do see discretionary spending moderating in coming periods because eventually the interest rates are going to impact discretionary spending.
And last year you finished your divestment of the retirement part of your company. How's the new leaner business looking now?
It has simplified our business because it was a large part of our business. Our balance sheet has been strengthened, especially in these rising interest rate environments. And it has allowed us to focus on the growth pivots that I mentioned of logistics into our living sectors. And of course, we are growing our land lease communities business quite well. You saw a big contribution from that business in this half, and going forward, it will be a key driver of our earnings. So we're very, very pleased with the progress on strategy we're making.